Hi everyone. Thank you. Apologies for that. Everything ready except for the disclaimer, which, as you know, we have to have before the start of each webinar. So welcome to this morning's session. And we've also been somewhat, not distracted, but we've been looking at some price action that's been going on on the charts. But before we start, as usual, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. Just very quickly, for those of you maybe who've come along for the first time, this is your first time here, we'll be looking at the markets through the prism of for volume price analysis, which is the methodology that David and I have been using for many years and which is now all explained in the books that are up on Amazon, but along which is sort of technical analysis, the chart analysis that we look at. But to that, we also look at what is going on in the fundamental space and also related markets, and there's been quite a lot going on certainly to do with that in equities and in the bond market as well, because essentially if you want to trade Forex successfully and you want to be consistent and you want to do this for the longer term, you really have to incorporate into your understanding of how this market works, not just what you see on the chart, which is obviously very important, and that's where we all start, but the chart doesn't operate in isolation. First of all, the drivers for the price action, what are the drivers? Is it a piece of fundamental news? Is it the central banks? Is it a geopolitical event? And also much to that, we also have to add that the four capital markets, of which Forex is one, we've got the Forex market, we've got the equity market, the bond market, and the commodity markets. They don't move in isolation. They don't move in their own little universe. There is this relationship. They have this they are all interrelated. What a move in one will be reflected in another, and sometimes a move in one will actually foreshadow, if you like, what is going to happen in another market. This is all explained in our Forex program. I know we've got some of our students here today. And what we've also done is to help us with understanding the flows that are going into the Forex market on an individual currency basis and currency pair basis, because we've actually developed some specialist indicators, which we'll see on the charts, because what the Forex market actually reflects as well is sentiment. Is the sentiment positive, or is it negative, or are we in a sort of transition phase? What is known as risk on, risk off, or what I like to call it now is RORO. What is RORO? Is it positive RORO, or is it negative RORO? But as I said, the best way to see all this is actually on the chart. So I'm just going to flick that down. If you've got any questions about what we say, if you're one of our students, if you're one of our quantum users and you want something explained to you, please just put the questions into the chat box. But if you're a first-time visitor and you want to know a little bit more about what we're saying, again, just drop your questions into the chat box, and David and I will be more than happy to clarify things for you. Right, so as I said, what we have to look at, flows. We've got a little saying in our Forex program, and those of you who come along and know us, is that we kind of define this market as levels and flows into individual currencies and into the different currency pairs, and we have levels that are on our charts, of which are important to the market, to other traders. Now, those levels can be measured, can be put on the charts in a number of different ways. People use Fibonacci, people use moving averages, people just draw them on their charts freehand, either diagonally or horizontally. The choice out there is endless. We use the levels that we use on our charts are constructed in two ways. They are both price-based levels, and I just flick one up just to show you very quickly. This is from the MT5 platform. These are the lines that you see across here. When you have a solid line, it means that that level is perhaps a little bit stronger because it's been tested on more than one occasion, or you have it as a hatched line, which tells us that level is a minor level, perhaps. As you can see here, it has been tested and they've gone through. Then it met the price action met a stronger level, but it still went through, and now it peaked through this one and has now pulled back. That's price-based support and resistance. On the Ninja platform that we'll have a look as well, we have a price-based accumulation and distribution indicator. It works in a slightly different way, and David tends to use Ninja more than I do, and he will explain that in more detail when we move over to David. But we also look at the support and resistance through the through the prism of volume. So we have volume-based support and resistance, and the most important level on this basis is the volume point of control, which is this yellow line here. This marks the area of the chart where, if you like, the price is in balance. It tends to be moving side. It will always be in an area of congestion, as we can see here, and the price is waiting to break either to the upside or the downside. And the histogram that you see at the back here, what that tells you is the amount of volume that is being built over time. So if you like, it's price, volume, and time. Time is really important, an important element of this indicator. And you have these lines across here, which are also support and resistance, but with volume. They're not as critical as the fulcrum point on this chart, but you will often find that not only will the price action stop at a price-based support and resistance, but it will also stop at a volume point of a support and resistance. And finally, what we also have is we've taken this one step further, and that is we are looking at support and resistance levels using the Camarillo Principle. This is an indicator that we have developed, and what it does, it gives them, the way I describe it, it gives a kind of hierarchy to the levels that you see on your chart. You will see a line either displayed from a price-based perspective or a volume-based perspective, but what we've tried to do is give it some weighting in terms of its importance, and this is why we use, as I said, the Camarillo. A lot of traders use Fibonacci. It kind of works in the same way. Those of you who use Fibonacci will know that certain levels are considered by the market to be much more valid, if you like, so that people take reversals or breakouts or what have you. We've used the Camarillo. We've calculated it on 6 levels. I suppose that the two most important are the R4 and the S4, which if you use the Camarillo protocol in its classic way, the R4 and S4, if price actually gets through, it's considered a valid break, if you like, but we've actually taken it to 6 levels, and we've also calculated this indicator in such a way that for all the time frames up to, but not including the hour, the levels are refreshed every 24 hours. So you get fresh levels every time the market rolls over. But once you go up to the hourly chart, the levels that you see here, these are going to stay on this chart for the remainder of the week. And we also have some very long-term levels on the weekly chart, which are actually valued for the rest of the month. Now, what that tells us, what that helps us with, is when we use our multi-time frame approach, which we do, when price reaches a significant level, maybe the R4 or the S4 or any of these levels that you see on here, and it pauses, which it always does. When you look at a higher time frame, and if that level corresponds to a significant level on a higher time frame chart, it makes that level stronger. So what that means is the pause may be longer, and if it is going to break through, it is going to take a lot more effort. It will require volume, and it may require momentum. And what it does, it is, as you watch price action, and price action is fascinating when we watch a chart, is you can anticipate, you know, what is likely to happen when that price action reaches a particular level. You know that at the very least it will pause. So in your mind, you're not trading with in a heightened state of uncertainty and anxiety. This market is uncertain and anxious at the best of times. It triggers those emotions. But having that kind of information on your chart, along with the indicators that we've developed as well, at least you know what is likely to happen. Now, of course, you know, markets are hit by all sorts of other factors, geopolitical, you know, items of fundamental news. Now, the good news about the fundamental releases is that we do know when we can expect them. And just very quickly, just to wrap up this little introduction, what we've had so far, well, overnight we've had the BOJ. We've had the interest rate, well, the policy rate, well, you know, there's really no expectation that it certainly wasn't going to rise. I suppose they could have cut it even further. There's been a statement, and now we're actually waiting for, they usually have a press conference, but it's all a bit, I'm not sure if it's going on at the moment or it has been going on. What we've also had is we've had some unemployment data for the UK, which has come out at 7. We've had the number of claims of not as much as last time, but more than that's been anticipated. But I think the one that markets picked up is the unemployment rate, which has gone down. It's gone back to what it was last month. I'm always slightly puzzled actually when they, you know, this happens with the US labor statistics as well. Is you have more people unemployed, but the rate actually goes down. I've never really found a satisfactory explanation to that, but no matter. The rest of the day, we have what we have to look forward to. I know it's later on. We've got the US retail sales, and more importantly, we have Jay Powell up later to testify. This is a 2-day session that he has in front of one of the committees, who are the Monetary Policy Report, the Senate Banking Committee, where he's going to be asked all sorts of questions by the politicians. And the one thing we can be sure about that is the market will be on very high alert, and there will be volatility. We've had a lot of volatility since last week, when the market had a bit of a swoon. That is going to continue. We'll talk about volatility, how we have to deal with it, how to identify it, what we can do as traders to mitigate that as much as possible. So there's a lot going on. There's been a lot going on the charts. I've actually got the pound Aussie. I think David has as well, but purely by coincidence. And the reason is it's because partly because it's one of the pairs that I like to focus on, but also it carries on the narrative that I have for the pound Aussie that I started on my Facebook page. But what I'm going to do, I'm going to stop there, pass over to David. We've had the London Open, and we'll come back to cover some of the topics that I've raised in this introduction, not least about the central banks, because there's a lot going on in central bank world. Certainly today, and coming up this week, we've got the BOE as well, and that is one of the really key aspects of trading that we have to get to grips with, is what the central banks are up to. And if you haven't done that study before, I think you might be quite surprised at some of the things that they do get up to.